Good afternoon, everybody. Welcome to today's second live webinar from Interactive Brokers. You can check out our listings at ibkrwebinars.com. And I'm delighted to have with me today Dan Sheridan from Sheridan Options Mentoring. How are you, Dan?
I'm doing good, Andrew. How's everything with you?
Yeah, everything is just dandy for an FOMC day, which makes me beg the question. Is today a good day to be doing one-day Iron Condors using SPX options?
As Sylvester Stallone would say, he uses the word absolutely, absolutely not. Yes, and that's definitely something I will address today. When might be a good day and when might not, but today definitely, in my opinion, wouldn't be a good day. I mean, could be. I mean, it could be a kind of a dud, right? But it's not the day that would be first on my list to do a one-day trade.
All right. Well, let me go through my little bit of housekeeping, and we'll come on to the subject in a second. And thanks again for joining me today, Dan.
Sure.
On the screen today, folks, the disclosures from Interactive Brokers. We're going to be talking about options, and on the screen is a disclosure of potential risks of trading options. If you have questions for Dan throughout, please do use the GoToWebinar software there. Go into the questions panel and ask your questions. I'm going to keep an eye on them, as will Dan. And actually, Dan, I'm just going to make you an organizer so you can see them at the same time.
Oh, great.
Just a little word of warning. We've had a few audio issues earlier today on one of our webinars, which was a GoToWebinar problem, not an Interactive Brokers problem. So if anything like that happens, we'll just hope to keep the flow going regardless. But I'll keep it. I've got my ear pinned to the audio here. Okay. Who's that good-looking gentleman on the screen?
It's not. It's a younger version, and that's always a good tactic, Andrew, to put a picture of yourself years before. And yes, only wish we a few more gray hairs and stuff, and a few more pounds. Yeah.
All right. Well, so this is a live event. There will be a recording link sent to the audience a couple of hours after Dan's wrapped up speaking here in about 40 minutes time-ish. So look out for that. If you have questions, use the question panel. And there is a handout available from the handout section. So expand that and download the PDF. You can save it to your computer and look at it whenever you want. And ibkrwebinars.com. Go and have a look under our contributors and find Dan's previous events under Sheridan Options Mentoring. And you can look at all of his wonderful events from 2021. And we're hoping we'll have Dan back here in 2022. With that said, Dan, I'm going to go on mute and just operate the slide.
All right. Thank you, Andrew. It's a pleasure to be here again with all of you. And today is kind of an interesting topic. It's a fun topic. It's a strategy that I think I would do with a very small portion of your available capital that you use for trading. Again, I think it's fun. It's got a little bit of what would I say? It's got a little bit of excitement. But there's some things I really like about it. And again, everything has risk, right? I mean, there's nothing with options. You know, how often I find this statement kind of interesting. How many of you that are listening today think a strategy like a covered right? Would you think that is conservative? I don't know. And you say, what is a covered right? A covered right is, you know, I buy 100 shares of stock in a stock I like long term, and I'll sell an out of the money call against it for a little bit of extra income. How many would think, we're getting any responses? How many people would think that's a conservative strategy? Anybody?
Dan, you should be able to see the questions.
Look under question. Okay, so yeah, thank you. Dorothy and Frank and Raj say yes. But if I asked you, Dorothy and Frank and Raj, if I asked you, hey, do you think it's conservative to sell a put, to just go out and sell a put? Is that conservative? What would you say? Would you say yes or no? So since Dorothy and Frank and Raj are interacting, they're my three friends now. So you have to answer that second question. If somebody said, hey, Dorothy, go sell a naked put, or Frank, go sell a put, is that conservative? Yes or no? Let me see if they answered. I think they did answer. All right, they would say no. Now, here's the thing. How many of you know, if you look at a graph, that a covered right and a short put, naked put, are the same thing? How many of you are aware of that, right? How many of you are aware and I didn't mean to give you a trick question, but how many of you are aware it's the same stinking thing? Excuse the word stinking. It's the same thing. It's the same strategy, right? Right? It's conservative to have a covered right, buy stock and sell call. But if you look at the graph, it's the same graph as selling a put, right? Anyways, so when I look at this strategy, a one-day Iron Condor using SPX, and thank you, Andrew. This is for educational purposes today, and that's that, right? That's what a disclaimer says. Yeah, and you could read that, but we can go to the next slide. But when I look at a strike, to me, I'm not an option trader. I'm a risk manager. Everything I look at is from that type of mind, right? And so when I look at a one-day SPX Iron Condor, and really what we're doing is saying, take SPX or whatever vehicle, sell an out of the money call, sell an out of the money put. We're creating this range in which we make money, and then we're buying a call and put against it for a hedge. But we're creating this window where we make money, right? And an Iron Condor is simply an out of the money call credit spread and an out of the money put credit spread. How many are aware of that? Is there anybody who's not aware of, never heard the term Iron Condor? I remember a rock group in the 70s, it shows my age, was called Iron Maiden. I never understood why they got Iron Condor. Were any of you admitted rockers and remember a band by the name of Iron Maiden? And I wasn't familiar with just the name. I couldn't tell you any songs they did. So is there anybody who isn't familiar with the term Iron Condor and that aren't aware that it's a combination of a call credit spread and a put? So let me start out by saying, right, the number one, let's go through this, but I'll regurgitate some comments, but the biggest thing is, what would be, do you think, the number one reason that I like this type of strategy? What would you think would be the number one reason? And again, are you all aware, in SPX is the vehicle I would be doing it, you have 3 expirations a week, right? With the weekly options. You have options expiring every Monday, options expiring every Wednesday, and options expiring every Friday. Are you aware of that? So you have 3 expirations. Are you guys aware of that? But what I like, number one, why I'm even talking about this strategy today is one thing, right? I can come on Monday morning or Wednesday morning or Friday. I could play one of those 3 days or none of them. So I have that choice. But number two, if I come in Monday morning, a half hour after the market opens, do I avoid the overnight gap risk? Yes or no? If the market opens down 1,000 points, or up 1,000, am I affected any way whatsoever if I'm going to enter the trade maybe a half hour after the market opens? So the number one reason I like this trade is it gives me that thrill, right? It gives me that, double latte from Starbucks in the morning. It gives me something with a little more juice to it, but I don't have to deal with, I can come in on a Monday morning or a Wednesday morning or a Friday morning and say, okay, this looks like a relatively quiet day. I'll play. Or SPX is down 100 points. I won't play. Or today is Wednesday. The Fed meeting is coming out some point today, and sometimes they can move the market. But with this public information of a Fed meeting, do you think it would be a good idea to play a little bit of a range bound strategy? Yes or no? Would you play today in a one-day trade that expires at the end of the day? I probably wouldn't, right? I probably wouldn't, right? So you could play Monday, Wednesday, Friday. You could play Monday. You could play Wednesday. You could play none of them, right? But the nice thing is you're putting the trade on. Does everybody understand the basics of this? You're putting the trade on, let's say Monday at, 9 o'clock Central, right? And you're out by probably 1 or 2 Central. So does that part of it appeal to you, right? Does that part of it appeal to you? The fact that nothing goes home overnight, it's like a normal job. You either make your money or don't. Does that appeal to anybody not to have any risk on going overnight? You should be saying, yes, Dan, that does appeal to me, because that it is. Now, Frank says, in a good point, would that be considered day trading SPX? Yes or no? I think it would. If you get in and out of a trade in one day, would that be considered day trading? Yes or no? I think it would. Andrew, wouldn't it? I think if you're getting in and out of a trade in one day, and I know some brokerage firms, I'm not sure what the policy is at Interactive Brokers. I'm not sure, maybe Andrew could comment on that. I know some brokerage firms, if you have $20,000 or $25,000 in your account, no problem. If you have $5,000 or $10,000 in your account, they may look at it as day trading. Andrew, do you have any thoughts on that?
I don't have any, nothing from a compliance perspective, but simply I would kind of consider it more of a binary outcome, right? It's yes or no, as opposed to buying something with a view to selling it higher. It's going to be kind of it's a yes, I make money, or no, I don't make money, right, Jen?
Yes, yeah, but because you're getting in and out, it's like you're let's just, instead of an Iron Condo, let's say you buy a call today and you get out of it by the end of the day, right?
No, then yes, then I would consider that day trading.
Yeah, and I think, and I wonder with this, you're doing an Iron Condor today and you'd be getting out at the end of the day. Yeah, I think they would require that day trading, but again, different firms have different requirements that, some firms have. If you have over $20,000 or $25,000 in your account, you can do that all day long, right? So I think it depends.
And I guess the feedback you're getting here, Dan, is well, couldn't you just let it expire?
Yeah, that's a good point. You could let it expire, and that is definitely one of the things you can do, right? But I still, it's nice to have the idea, if you have it on and start moving against you, right? take it off. So I would rather have the ability to take it off if it goes against us, because if we're just going to let it expire, then there's not as much risk management to me, right?
Right, and you did actually specify as well, Dan, you know, that you want to be out of this by what, 1 Central Time?
Yeah. And so folks, I'll run through this with you, and I'll give you my thoughts on it, and we'll go from there, right? Let's go from there. So, and again, on anything, this is a craft, right? Whatever strategy you take with options, I consider it a craft, and you start small on paper and make sure you understand it, and then you kind of move from there, one contract, and learn it the right way. Now, criteria. So when I'm looking, and this goes into the, so I'm starting out here, Andrew, with, I'm not getting into the nuts and bolts of the strategy yet. I'm getting into kind of criteria. What in the world, you know, do we play today, right? It's like if Andrew goes with his family to the ocean and he's got some young kids and they say, Dad, can we go swim in the ocean for 4 hours? Well, he's got a criteria, right? A, are the waves too high? B, is there lightning? C, is Jaws waiting there for the kids? You know, and once he makes the assessment, okay, it looks good, go on in. But if any of those things come up, he would get them out. Well, what criteria would I look at? So first of all, and I don't even think I mentioned it here, number one, and I go through this quick checklist every Monday, Wednesday, and Friday morning, right? So first one is news. Now, it has to be something significant, right? Because as Andrew and I would both say, and most of you would know, is there news every day? Is there news every day? Yes, right? And most news is already discounted in the market, but like this Fed meeting, you know, there's some news that is a little more significant than others, right? So I would look at the news. Also, I would look at the last, you know, when I'm trading something today, not that it's not important what happened a year ago, but it's really not that important to what's happening today. If I'm looking at today, the farthest I would go back and look at the market the last 2 weeks is it ranging or trending in the SPX, right? Are we in a little more turbulent period? And if I'll show an SPX price chart here in a second, but we've had a bit of turbulence in SPX since early September. We really haven't been range bound. So I would like more of a range bound, right? If I had a pick on a range bound trade, makes sense. Then I look at something called, I'm aware of, something called ATR. How many of you are familiar with what in the world ATR means? Any of you? It's called average true range. In English and Spanish, what does it mean? It just gives you an idea. If you're trading SPX or any vehicle, Apple or whatever, it takes the distance between the high and the low. So it's saying, you know, if SPX, the difference between the high and the low is 100 points, you know, that to me is pretty, you know, that's a big range. And if I'm doing a range bound trade, I don't really want a high ATR. I want a low ATR, average true range, because that takes into account the high or the low. So I don't want, again, as a range bound trader, I don't want a big range. The other thing is I look at VIX. You know, I'm more comfortable with a range bound trade when VIX is in kind of the normal range of the last month or so, right? The normal range. I don't want anything, you know, if VIX is too high, that means the market is tanking. Tanking doesn't mean range bound. If the ATR, and that's really my biggest concern, but I'm looking, you know, if the VIX range is 15 to 22 or 23 over 6 months or 6 weeks or a month, I want to be in a normal range. Another thing I look at, again, and I'm doing this very quick in my head, moving averages. right? We've been, I think everybody would agree, we've been in a uptrending market for quite a while, and we're above the 50-day and the 200-day moving average, two simple moving average, two normal things people look at. So as long as we're in an uptrend, I want to make sure of that, right? If suddenly we break through the 50-day moving average, you know, I'm just looking at things that would not go along with the word range bound, right? And then I look at today's move. If I come in on a day where SPX is up 1.25%, or down 1.25% at the opening, might that be a day I'd pass on, right? For a one-day trade. In other words, what in the world give me one word as I was grasping here with the first point on criteria. What am I looking for? If you had to sum up one word of what Dan is looking for to do these one-day range-bound trades under criteria, come up with a word that I'm looking for. Indicate, but what am I looking for? If your 3 kids come to you on Miami Beach and say, hey, Dad, can we go in the water today? What are you looking for? What the heck are you looking for? Peace, stability, tranquility. You with me? Right? Quiet water, no waves, peace. You know, if SPX is up 1.5% or 70, 80 points, is that peace? Right? If ATR is going crazy, is that peace? If VIX is not in a normal range, nothing to do with peace, right? Time to enter trade. Every Monday, Wednesday, and Friday, time to enter trade. I'd start looking at it about a half hour after the market opens, right? So I look at the criteria, go over news. If that all seems to make sense and make you comfortable, then I would look sometime between 9 and 9:30 Central Time to initiate my salvo. Everybody with me so far? Does that make sense so far? Yeah, and again, I'm using SPX. This strategy can work for SPY. I mean, like I said, can work. I mean, you can do it in SPY. SPY is just 1/10 the size, right? It'd be a cheaper doing it. Setup, all right? So how would I set this thing up? I like to set this up generally equidistant. Doesn't have to be exact, but if I'm going to go 40, 50 points down, 40, 50 points up, generally, here's some of the mechanics in the setup. You're with me? So how would I pick the short put? A 20 delta. How would I pick the short call? A 10 delta. I would normally do this, and I'm going to give you an example. I'd normally do this 10 wide on my credit spreads. That's my width. I don't want to get under $1 credit usually. But you say, Dan, why are you picking your short put by looking at the delta of 20, and why are you picking your short call at a delta of 10? And that's because the volatility, the skews in the indexes, if I want to get something a little more equidistant or balanced, what does that mean? Where my short call and short put are, you know, in the ballpark, the same distance, right? That's what I would need to do. Ryan says SPX has tax advantage also. Yeah, correct. Do I consider delta? Yes, Frank. That's kind of how I pick the short strikes, based on the delta. Because now, folks, let's talk about that. If you're selling a 20 delta, what does that mean? 20 delta means there's only a 20% probability that the SPX is going to finish under that strike by the end of the day. If it's a 10 delta in the call, there's only a 10% probability that we're going to finish over that. Are those good probabilities? Yes. Question by R. Johnson says, Dan, would you have a pre-market anticipation, or is this trade totally on the fly based on the day-to-day conditions? Well, let me answer that. So pre-market, if you go to CNBC or something, do you have an idea, a rough idea, how the market's going to open up? Yes or no? Based on if you look at CNBC or pre-market, do you have a rough idea how many points SPX will be up or down? Yes or no? So based on that, based on the pre-market action, if it says SPX is going to open up 5 points or down 10 points, and there's no news for that big significant news, would that be a good candidate day for this strategy? Yes or no? Would that be a good candidate day for this? So if I see SPX is going to open up or down 10 points, there's no big news, can I tell based on the pre-market a little bit if it might be a good candidate that day? Yes or no? Yes or no? Yeah. So I have an idea in the pre-market if this is going to be decent. If it says SPX is going to be down 70 points at the opening, it's probably a good day to golf, right? Now, risk management, profit target and max loss. So the way I look at these is, here's how I look at this game, right? This is a game. Simple risk management, right? Forget the word that it's an Iron Condor. You could call it whatever you want. If Iron Condor bothers you, call it your favorite sports team. If you're from Chicago, call it the Chicago Bears. Doesn't matter what the name of the thing is, right? It's what the graph and everything is. But risk management is going to be this. I'm looking at this as a long ball game, right? So what does that mean? I'm looking at over a year, if there's 3 expirations a week, and let's just say we even play one of those 3 expirations every week. How many of these would we put on in a year? If we even just play one of those 3 expirations a week, how many of these would be put on a year? 52. So let's just take for an example, and let's round it to 50. You say, why? I can do math better on 50 than 52. So let's say you're going to put on 50 of these, right? And let's just say your goal is to make, I'm just throwing this number out there, right? We'll get to it in a second. 7%. If you're going to probably win on a majority of these, but let's say you're going to win on, the goal is to win on, you're going to win on 40 and you lose on 10, and you make 7% on your winners, and your losers, you keep it under 10%. Is that going to be a pretty good business? Yes or no? No, you shouldn't be seeing a graph yet, not yet. I'm just trying to talk to you a little bit about this. I'm trying to get you a feel of how many understand what I just said, how I'm looking at the risk management. I'm looking at doing this 50 times a year. If I'm doing it once a week, if I do it twice a week, that'd be 100 times a year. If I do every Monday, Wednesday, and Friday, it's 150. But can everybody just conceptualize as a business owner, whatever my profit target is, if on a probability trade like this, we're going to win quite a bit more than we lose, and we can keep our losers near our winners, does it make sense? Yes or no? Yes or no? So what do you think is the most important thing in this strategy? What do you think is the most important thing? What do you think to be successful at this strategy? It's number one, consistency. You got to play at least once a week. You got to have enough at bats, right? And number two is risk management, or simple, we're not going to do adjustments on a one-day trade. When you're down X amount, when we say you got to get out, you got to get out. But what character quality is that to get out when you're supposed to? Is that a big knowledge of options? What's the most important thing involved in this? Is it how smart you are? What word is it called? Begins with a D. Discipline. Period. Period. But Dan, I don't understand the Greeks and the Goks and the Greeks and all the, I don't care. It has nothing to do with it, right? If you're supposed to get out at your appointed time, you can't be, you got to get out, right? Period. Right, so that's why I was talking a little bit with Andrew at the beginning. Is it probably a wise strategy just to put these on and let them expire? Do you think it's a wise strategy just to put them on and let them expire? I'll tell you why. No, because you're going to see in a second why not. And it's because, the risk reward won't be there. Usually, here's what happens. If you have a trade with great risk reward, the probabilities probably stink. If you have a trade with great probabilities, let me say this. Yeah, if you have a trade with great probabilities, you're going to have a bad risk reward. If you want a great risk reward, you're not going to get great probabilities. Now, position size. What do you think position size you should do? Thomas, Frank, or Steven? What do you think? What do you think? What do you think? Let's see if you're all on planet Earth. What do you think for position size? What do you think? Should you do 100 of these? Should you do 50 grand trade? What do you think? Any comments? Trade small. I mean, if you're learning a craft, whatever gives you a 1% loss of run. No, the correct answer is it's not, trade small, trade often. I don't get some different thoughts on that, but it's if you're learning a craft, right? We want you to know what you're doing, right? So if you're starting to do this, whether you have more capital or less, you should do one, right? And learn what you're doing, get good at it, right? So, I would trade one, right? I'll just leave it at that. I would do paper trade and then trade one contract. As I said, the best parts of this strategy is the fact that there's no gap to me. Now, the other slides will go quicker. Andrew, could you go to the next slide? Andrew, are you there? All right, thank you very much. So this is just a graph. I'm going to talk about a few things that I like on my graph to look a little bit. I'll look at a 50-day moving average, a 200-day moving average. I have a chart of what the implied volatility is, the option volatility, and the average true range. So again, we've been in an uptrend. So as long as we're in an uptrend, right, that's kind of the status quo. We've been there. If we kind of nail through the 50-day moving average, just some basic, that could be the trend is changing, those would bother me, right? So those are things I'm looking at. Implied volatility, are we in a range over the last 6 weeks or 4 weeks? Average true range, I generally want that trending down, right? because that means the distance between the high and the low is getting less, right? Yeah, SPX is a big boy, but again, you can do, I'm going to talk about 10 wide credit spreads, but if you do 5 wide credit spreads, you can do an Iron Condor and SPX for $400, right? Right? Is that crazy capital to risk $400? Yes or no? Is that crazy capital to risk $400? Say no. Can anybody say no? No, it shouldn't be, right? No. So you can do an Iron Condor. I'm going to show an example that the width of the credit spreads are 10 wide, but if you want to do them 5 wide, your total risk, if the world ends, be about $400, right? If the world ends. Now, Andrew, let's go to the next page or the next screen. So here's first example. Now, getting these slides in, I just gave you, just so you get a feel of this. I wasn't able to get one on the same day, but I've got one. So here's an example, Dece 10 Iron Condor, that's the expiration, right? And it was entered December 8th, right? So 2 days before, just so at least we can talk about the strategy. So here's, just so you can get used to the strategy. So this is the Dece 10 expiration, enter Dece 8th. I normally would enter this Dece 10 in the morning, but at least we can get used to the strategy. So if you look here, you can see the call credit spread. I'm selling the 4760 calls in red. The green graph is expiration. The purple graph is the day you put it on, right? Everybody see that with the graph? So I'm selling the 4760 calls and I'm buying my hedge 4770, 10 points away. That's called a call credit spread, a bear call spread, or whatever you want to call it. The puts, I'm selling the 4640 put and I'm buying a 4630 put 10 wide. You could do it 5 wide. Instead of buying the 4770 calls, you could buy the 4765s. Instead of buying the 4630 puts, you could buy the 4635 puts, and then it would be about a $400 capital trade. Now in this example, you can see by selling the 4760 calls and the 4640 puts, about how many points out of the money am I on my short options? About how many points out of the money am I for my short options? And this would be with 2 days to go. How many points? How many points is my short strike out of 60 points? And that's my range at which I make money anywhere in there. Now, in this example, when I looked at it, the credit was $1.60 and my margin was $8.40. Does everybody understand how I came up with margin of $8.40? So if my credit from selling the call credit spread and the put credit spread got me $1.60 total, your risk is the difference between the width on the call side is 10. The difference between your risk on the put side is 10. So your total risk for this trade is $1,000 less your credit of $1.60, 160 would be $8.40. So when I put this on margin of $8.40, that's my risk. Does everybody understand that? Yes or no? Yes or no? The credit and the margin. I'm happy to go over it again if you don't. Does everybody understand that? Yes or no? Now, let's talk. So again, this can be very simple. Now, so let's just say I did make the whole credit. So that everybody agree, the most I could make is 160 divided by capital of 840. That's about a 19% yield. Does everybody understand that? Yes or no? I took the credit that I'm bringing in $160, divided it by my risk, right? If SPX goes down 1,000 points or up, the most I could lose is 840. We're looking at a potential 19% return. Does everybody see that? Yes, no? And again, the way I picked the short strikes, this is called an equidistant Iron Condor. I sold a 10 delta call and a 20 delta put. That's how you get roughly. It doesn't have to be exactly equidistant, but that's what I did. All right, is everybody with me so far? You guys are with me, and ladies with me so far. So if the most I could make is 19 or 20%, I'm going to go for half of that or a little bit less. And that'll get me out quicker, right? So I might look at somewhere between 8 and 10%, right? So if I'm trying to make, let's just say 10% on the margin, how much is that? Round it, round it. Approximately, if I'm looking to make 10%, what is that in dollars? If I want to make 10% on my capital, $84, Frank says, right? So it's not 10% of the credit, it's 10% of your risk, 840. Let's round it to 80 because I can do math better on 80 than 84. If I sell it for $1.60 credit and I want to make about 10%, where do I buy it back for? If I sell it for $1.60 credit, where would I buy it back for to make my 10%? So I'm taking $1.60 credit. I estimated, I just rounded it to $80. I'm going to buy it back, sell it at $1.60. I know officially it's 84, but I'm making it 80 because I can do math better on 80. $1.60 credit from 80, where am I buying it back? Where am I buying it? 80-cent debit, right? Right? That's the profit side. And the loss side is saying, okay, because again, it's okay to lose. It's just, if I do this enough occurrences and I limit my losers, it's okay, right? So, and let's say to let the probabilities work a little bit, right? Because a lot of times we could go up and then come back or go down and come up. I might give it a little more rope. So here I was looking to make 10%, which was about 80. Let's say we have the loss closer to 15%, right? What would be 15% of 840, roughly? 15% would be 125 bucks. Let's call it 120, right? So let's call it 120. Are you with me? How many are with what I just did, right? I want to give it a little more rope, right? I'm looking to make 80 bucks. And if I lose, I just rounded it, Frank. If I lose 120 bucks, I get out. So if I sell it for $1.60 credit, at what point do I get out? What's $1.60 plus $1.20? What's $1.60 plus $1.20? So at 280, I get out. And let's say the market's going down. When you see the trade value at 280, in practicality, how would you get out of it? Let's just say we're going down. If we're going down and I'm getting out for my max loss, the call side will be trading for nothing. So I would just buy the put side and call it a day. Same on the upside. Does that make sense? Because in reality, you know, if you're getting out when that 160 credit hits 280, because let's say we're going down, the calls aren't trading at anything by that time, right? Just buying the put side. And on the upside, just buying the call side. Does that make sense? Does that seem like how many think that plan that I just went over, that if they practiced it a little bit, they think they could do that? I didn't get into the Greeks and all that stuff. How many think, right? Yeah, I think you could too. Now, why am I not talking about rolling it or adjusting and stuff? Why do you think? Why am I not talking about rolling it or adjustments or any other jujitsu? We don't have enough time, right? And there's not a lot of adjustments to do. The thing expires, right? We're only going to be in this trade probably about 3 hours, 3 or 4 hours. Does that make sense? Think of the risk management style. Think of the movie Karate Kid. Remember watching Karate Kid? How did the guy teach him? Wax on, wax off. Wax on, wax off. Put it on, get your profit or your loss, next, right? Robert, you said, what does this mean? Give me a little more information on that. If you were assigned, you could just write calls against to make it back since you're holding. Now, according to the risk management I've given you, should you ever come close to an assignment? According to the risk management that I've given you, should assignment be something that you should even visit? Not at all, right? And it's cash settled, SPX. So it's not relevant, right? Even if you were, we're getting you out, you don't have to worry about that. You're getting out of the trade. There should be no problem. Yeah, there is no, right, SPX, there is no assignment. Let me see if I missed a question. So I'm just talking practicality. If the market goes down and you hit a max loss, the reason I don't get out of the whole Iron Condor is because the calls will be trading at zero, just by the put side. And on the call side for a max loss, I just get out of the call side on the way up. Now, for a profit, I get out of the whole thing because there'll still be some value. Question says, can I do this on RUT? Yeah, you could do it on RUT. I just think overall SPX seems to be a little bit more range bound, but RUT if it's range bound, I think would work too. Now, Dorian had a good question. It does mean you have to be glued to the screen. Now, let me ask you a question. Could you do this, right? Do you have to be glued to the screen? So that's a great question. Let's talk about that. Well, once you do the trade in the morning, can Dorian put an order in to take it off at her 10% profit? Can that be automated? Yes or no? Can that be automated? Yeah, so you can automate it. And then again, every brokerage firm is different with the orders they put, but you can put some, you can put some orders in, maybe an OCO. I have an order to buy the call spread back for X amount or the put spread back for X amount, and you can tie them, whether we go up or down, like they call it OCO. In other words, there's contingent orders you can put in to automate it. So if you're out in the garden or you're something, you can automate this sucker, right? So no, you don't have to be in front of the screen all day. Now, Andrew, could you go to the next screen? And here, folks, is just another example of, you could see if we did it D10 expiration, if we entered it December 9th, right? And that's just another example. with time winding down, we don't need to go. That's just another example for you. And you can see, if you look at the theta along the left side, the theta is almost as big as the credit, right? So why? Because it's all happening in one day. So I would anticipate on normal days, you put it on within the first, never the first half hour, either from like 9 to 9:30 Central, but I would expect to be out of this by around, between 1 and 2 Central. I don't expect to be in this the last hour, generally. Yeah, Steven says you can set up an OCO order. Yes. Can do a profit limit. Yeah, different ways you can do it. Yeah, you guys are on top of this. Trailing stops. Yeah, but the bottom line is you can automate it, right? And Andrew, if you go to the last slide, or next slide, is there another one? Maybe there isn't.
That's it.
Oh, that's it. Okay. So folks, again, it's a simple methodology, but again, like anything else, it's a craft. Whether you want to learn to make fettuccine Alfredo, whether you want to learn to play tennis or hit a ball, I just wanted to give you some basic structure so that you could go off and practice the craft. And, I would stay with one contract, paper trade, make sure you understand it, do one contract, learn it, right? And then you slowly build it. But I think it's a fun strategy. Again, I like it because you can avoid that gap risk and you can pick the days you want to. But again, you got to be careful with the weather conditions. Since September, forget the Fed meeting. Since early September, there's been more turbulence. If you look at the price chart of SPX, I showed one. So you just got to be a little more careful, and you'll get better at it, right? But again, I think the key to success is going to be discipline, right? Because if you can keep your losers near your winners and you got a nice probability trade, you should do okay as you get better, but just keep the size small, right? Question says, is there a way to close it early without using up a day trade? Well, now you're going to be putting it on and getting off in the same day. So there's really no way to avoid that. I think I would just look at the requirements at Interactive Brokers for doing that type of a trade. Jay said, what about trailing stop triggered at profit target? Yeah, you can do, I think that works. And so, probably you'll have to learn more. I mean, the mechanics of this, I think, are pretty straightforward. You just have to get a little more familiar with the choices at Interactive Brokers for some of the contingent orders. What Greek values like delta, theta, vega you consider in strike selection? I'm just strictly looking at, I want this more of an equidistant Iron Condor, so I pick my short put with a 20 delta, the short call at 10. I don't look at, as far as theta, vega, I'm more concerned with just getting this thing balanced. So, folks, I gave you enough information to be dangerous. Practice the craft, small. Don't get greedy, and if you have a couple winners, you go from one contract to 20. No, approach this as a craftsman, and I think it might be a strategy you might enjoy. So, folks, I'll stay on here if you have any other questions. If not, have a wonderful day, and we'll catch up with you the next time. Andrew, as they say, take it away, Andrew.
Fascinating. Thank you very much, Dan. I have one kind of question that some people I've seen asked before, and I'm going to ask you so you can add some color here. So when you're basically your net short options here, so you're short delta, right?
Your net short what?
Delta.
You're net short. Yeah.
Not
I'm trying to
sure.
get it as close to delta neutral as you can. I mean, if you're like, minus 0.20 or minus 0.30, yeah, it's less than a half a delta short. So you,
Okay.
yeah, you
Let-
try
let-
to get as
let me-
close to
Let me
neutral
pose the
as possible.
question. Let's pose the question. You can answer it this way. So you're now trading an option, an Iron Condor with 4 legs, right?
Correct.
Who's the natural buyer of what you're trying to sell?
Good question. Yeah, I think I don't know if there's a natural buyer, but being that I was a market maker specialist at the CBOE for many years, that's our job, right? So, if someone came in to do it, that's our job, is to trade with the retail folk. And so it doesn't mean, so if somebody comes in and sells this Iron Condor as a market maker, it's not, I may look at that trade and say, hey, that's a good trade. But my job, first and foremost, is to accommodate the public. So if I think I can make 10 cents on, the thinking is different, right? I may buy that trade in, and then I'm parceling off pieces of that. Do you know what I mean? So it's not like if somebody sells it and I buy it, we're going to have a winner at the end of the day. Both can win, right? Because the minute that the market maker buys that from you, he may get rid of one side of that, or he's trading in and out of that, right? He's the only reason he buys that from you at that moment is because he's looking like undervalued, overvalued. He's thinking, you know what? As I get rid of parts of it or whatever, I can trade in and out of it and make 10 bucks or something. And if I do it enough volume, I can do well. So they're looking at it through a different lens than us doing it. So don't look at it, like, hey, they're going to hold it till 1 or 2 in the afternoon, just like me. No, half hour later, he could be out of the whole thing, right? If he could, we call it scalp it. If he can buy it from you for a certain price and somehow sell it in the next hour. So they're not looking at it like we do. Many a times when I was a market maker doing the opposite side of the retail trader, I liked what they were doing, but I had to think of them first before I could do what I wanted to do.
And I guess another part of the answer is also the price at which retail is willing to sell this versus what the market is, right?
Yes, and that's a good question. I didn't cover that as much. So what I do, folks, the concept of mid-price is a little confusing. In other words, mid-price is a moving target. In other words, someone says, I look at mid-price. Well, there is nothing, in my opinion, mid-price, because it's a move. I'd look at it, when I look to do this, I might look at the mid-price over a minute or 2 minutes, right? And you'll notice the mid-price will change, right, Andrew? So if you watch it for, let's say you watch it, you're ready to put one on, and you watch it for a couple minutes, you might see, even if the SPX is relatively stable, it might say, let's just say $1.40, $1.45, $1.50, $1.35, $1.40, $1.50. It's going to change like that. So then, because this is a credit transaction, I would start at the top of that range. If the range over 2 minutes was $1.35 to $1.50, because it's a credit, I'd start it at $1.50. Give them 20 seconds, go to $1.45, right? And go from there. And what I would do, Andrew, is even if I was going to do 5, I'd start with 1, because I want to get a good price discovery of where this is going for. So that's kind of a little bit how I would get execution on that trade.
And then Frank has a good follow-up question to that. He says, would you consider open interest for both legs? But The answer is yes and no. I mean, if you're talking SPX, then you've probably got, you're going to have open interest there. This stuff is liquid, but
Yeah,
not necessarily for either individual stocks or other indices for that matter.
yeah, and I mean, you could do other indices, you could do other stocks, but I like SPX because you don't really have that stock risk. But I would, I'm not as worried about open interest if it's a liquid vehicle, right? If we're an SPX, even if there's no open interest, it can still get it done. But if there's no open interest in a vehicle that doesn't have good open interest, now you got a problem. So I'm not as worried in SPX about the open interest as I am. And the other thing is, and I didn't talk about this, I'm talking about an Iron Condor, but somebody could, somebody if they wanted to could just do the put side, right? I'm not really good at technicals. Some of you might be much better at technicals than I am. So maybe the market opens down a little bit and you look at the chart, you might say, okay, I'll do the put credit spread first. And then when we go up, towards maybe the upper end of the range for the dip, maybe I'll try sell the call spread and kind of leg into it. I don't normally do it, Andrew, just because I'm no good. I haven't found myself too good at that. So I just put the whole, the bloody thing on. But if you're a little better at technicals than I am, which doesn't say much because I'm not good at it, you could leg into it or just do one side. But the way I teach it is just put the whole thing on.
Yep, makes perfect sense. All right, I think that's just about all the questions. We're just over an hour as well, so I'm not going to charge you any any time and a half here, Dan. No. Thank you very much to the audience for showing up today. Some great interaction there, and a recording of today's event will be available in a couple of hours. And Dan, you'll come back and see us in January.
I would love to, Andrew, and thanks for having me, and thanks for the good interaction today, everybody. And we'll and you know what? I'll think of some what would be helpful next time I come back and speak. If there's any topics that maybe you would like me to cover the next webinar, just send it over to Andrew. Send Andrew over, and if you have some ideas of something you might be interested in, and if we get more than one on the same topic, we can use that as feedback. But I'd be happy to try to what you guys are thinking. So have a wonderful holiday month here, and we'll see you in January.
And to that end, I've just put into the chat panel there webinars at interactivebrokers.com for your suggestions for future content from Dan. And let's see if we get any bites on that little hook there, Dan. Thanks.
All right.
And we'll see you in. Have a wonderful holiday season, everybody. And we'll speak to you, Dan, in January, mate.
All right. Thanks, Andrew. Thanks, everybody.
Thanks, everyone. Bye for now.